In today's video, we'll be talking about the potential restart of QE and the catalyst for oil and gold. This channel has always been support of precious metals for long term because the global movement for central banks and countries to move away from a US dollar as global reserve currency, because countries are noticing that US is using US dollar and US treasuries to export inflation to the rest of the world. And pretty much, hey, we can spend as much as we want and the rest of the world is footing our bill. For example, what we're seeing is, imagine you are a holder of US treasuries. You bought in, all these US treasuries over the past few years, and all of a sudden, US printed, massive massive deficits. They spend so much money, send it to everyone, and then how to foot their bill? They're saying, oh, now we have to fight inflation. Now we have to raise rates, and so you see the value of U.S. treasuries, U.S. Bond drop dramatically, and now you're stuck holding. You're down like 30-20%. If you want to sell, right, then you realize that loss. And that's one of the ways that US is taking advantage of the rest of the world, and countries are, working the hardest to try to move away from that to avoid that in the future. And I think as that continues, that's why I think long term, precious metals will do well. These are the topics we'll be going over today. We'll first take a look at the Fed balance sheet and continue to see, the trend going forward with OPEC plus surprise cut. We're seeing that, they're cutting more than what they have agreed on in the previous, October 5th meeting in last year. Talking about a little bit with real estate market, talking about equities market, how equities market is being really optimistic, and then finally wrap up with commodities. Please remember that all these are my personal opinion. Please do not base your investment judgment on anything I say. Please contact your professional investment advisor. So looking at the Fed balance sheet, so we talked about it on the week of March 15th. We can see that, from 8.3 trillion to 8.6 trillion, almost a 300 billion increased in the last video. Again, right now we're sitting at 8.7, and if this trend continues, then SVB crisis will mark the restart of QE. So again, this is another indication that the balance sheet will never ever be shrunk unless the Fed is willing to accept a complete collapse. Because what happens is all these, balance sheet increases, they buy all these toxic assets, give liquidity to whoever they want to bail out. And these companies that normally should have failed and would have failed if not for the Fed rescue, these are zombie companies that continues to live on but continues to have issues. And other companies also seeing that, hey, if anything, the Fed will just come and save us. Obviously not everyone, but those, who know that they are, quote, too big to fail, or maybe they have a friend or two in the Fed or federal government knows that they will be saved, so they'll continue to gamble with shareholders' money because they know that when they win, they can pay themselves either bonuses, stock buyback, big dividends, and if they lose, someone will save them. And so this will continue to happen unless the Fed is willing to let go. And, so far, I don't think that will be the case. Continue to kick the can down the road. And this is similar to what happened once from 2008, massive QE from Ben Bernanke. He said, this will be temporary. The balance sheet will be shrunk. They tried to do it, and it didn't happen. We have a restart of QE back, I think it was just below 4 trillion, and then we went way back up when COVID provided a great excuse for it to really blow up, and now looks like we might be back on trend and we might hit 10 trillion. We'll see. OPEC Plus came out with surprise cut. They're cutting 1 million barrel. This is on top of the previous agreement to cut on October 5th of last year. So the question is then, does OPEC Plus see the impact of recession coming, or already here, and is planning ahead to put a floor on oil prices? And remember how Biden administration mentioned, we're releasing SPR, strategic petroleum reserves, and we will buy it back, below $70. Now, I didn't expect oil price to actually go back to below $70. I thought maybe just the Biden administration putting that statement out there would be the floor for oil prices, because they're coming in and buying right away. But hey, good job. I didn't expect the recession pricing in to have that much of a bigger impact, and we actually saw oil prices below $70 for US crude for quite some time, and now it's moving back above. And the question is then, can oil stay above now with more and more confirmation that OPEC Plus is here to try to put a floor on oil prices, and possibly maybe sticking it back to Biden, not allowing US to rebuild its SPR below $70, because again, that is another big catalyst in the future. When is US going to start refilling its SPR? Because that again takes them away from a big supplier into the oil market, and change them into now a buyer. And how much are they going to buy? And if any more geopolitical risk occur that they need to prepare themselves, again, that is going to be another huge catalyst in terms of the demand side. Taking a look at real estate, we saw the rebound in home prices and sales as well. And in my opinion, I think it was just due to the lack of supply. And along with, we saw bond yields falling. Now mortgages all of a sudden are a bit more affordable than what it was when bond yields were higher. We saw 2-year up to 5%. Now it's much lower now. So the question is then, this is showing us that the demand is rebounding very quickly, meaning in the economy, people are still eager to look for a new home, and so we're seeing that there's still a lot of aggregate demand that's ready to jump when prices fall, or mortgage rates fall, which again kind of provides affordability, because the bigger mortgage you can have, or bigger payment you can support on a monthly basis, the bigger the mortgage can be, and that means the more money you can use to try to buy a house. And this is again proving inflation will continue to be sticky. But I do see a continue issue looming with, for example, commercial real estate. So as mentioned before, I do not expect commercial real estate to ever return to pre-COVID levels, especially with workers preferring to work from home, and also companies realizing I don't actually need everyone in these office space. Like, sure, maybe some workers are not as efficient working from home, but some cost and benefit analysis has to be done to see that is it worthwhile to have everyone come into the office, pay for commercial real estate, or is it cheaper to have them let them work from home, maybe not as productive, but you don't have to pay the commercial real estate. So again, that is something to consider. And along with recession, for example, if more companies fail, if the Fed doesn't save all of them, right? With inflation continue, if some of these companies goes out of business, even just for a period of time before some other business takes over, what's going to happen with that commercial real estate? What if not enough commercial, like we already see liquidity issue in some of the commercial real estate ETFs? What if that continues, right? So eventually, like, this is another issue, another uh, catalyst down the road. And another, a little bit longer term one, is refinancing risk. Now, people who either locked in their rates, for 5 years, a few years ago, now comparatively, their rates are probably gone up a lot more. Like if they were to get a mortgage today, or people who are paying variable mortgages. These people, maybe they're still doing fine, right? Or people who don't have to refinance yet. But what if now you have to refinance eventually, right? You have to refinance. Can you pay that higher rate? Another thing is, what if you lose your job? What if some people lose their jobs because of the recession? With inflation already eating up the disposable income, what if some of these people can no longer afford their mortgage payments? Then we go into foreclosure, right? And the banks, are trying to get liquidity in that case. Well, that puts more supply into the market. That puts more downward pressure on prices, right? This is a little a spiral that could kickstart, the continued downfalling in real estate prices. So therefore, in my opinion, I think real estate, we're looking to move towards a very favorable buying opportunity, but I do not think that we're there yet. For equities market, we see VIX back below 20. Is this it? Does that mean, we're going back to all-time high? We're good to rally for equities market, or is the VIX gathering energy before rallying back to $30? Right? VIX, a good indicator when it comes to the sentiment. We call it fear index. So, in my opinion, I think the VIX is gathering energy before March higher. And when that happens, then I think the major indices have more pain ahead. And the market is really optimistic with thinking, oh, bank crisis is over. My favorite being Jim Cramer. He's always the like whenever he says something is good to buy, like that's when you need to sell it. Whatever he says, just do the opposite. For the most part, you'll probably do okay. uh, he mentioned that, hey, we got to be happy that SBV blew up because now the Fed is coming back with more liquidity. We see balance sheet, QE restarting. That's why we're good to go. We're good to buy. Yeah, I don't think so. Even with the bank crisis, subsiding for now because the Fed has stepped in a big way. Over 300 billion over 3 weeks to help shore up liquidity and potentially, give a way out for any banks to kind of sell their toxic assets and get back par value instead of market value. There's still recession ahead, and these banks who've taken these liquidity, they will still fail again because they know that there will be more bailouts, or at least not all of them, but some of them will, the quote, too big to fail. And so they will continue to gamble because, again, all the gains are privatized and all the losses are socialized. And because of that, there's no incentive for them to not be reckless because they know they will be saved. And again, the yield curve continues to remain inverted. And we talked about this before when it comes to the bank's, cost, which is the short end of the yield curve, and the revenue, which is the longer end of the yield curve. And finally, we continue to see insider selling continues as the market is rallying. So again, it is something that they know that we don't know. And in my opinion, I think equities market is not out of the woods yet until the Fed is fully committed to, not only rate pause, but also maybe considering rate cuts as well, along with the QE restarting. I think that at that point, then we can be more optimistic with the equities market. Finally, let's talk about commodities. For precious metals, gold and silver, as mentioned before, I'm still hoping for a pullback, seeing a little bit of resistance for gold for 2000, maybe a pullback to low 1900s. If this doesn't happen, which is fine, it's just in short term, I do think it is a little bit overbought. But long term, like again, this is a hope. I'm hoping for a lower price so I can buy more. That's really it. Long term, I'm very bullish because of multiple reasons, with recession and also, the global trend to move away from US dollar, to move away from US treasuries. We see other central banks, they continue to buy gold. Now, gold was money, at least, in everyone's eyes prior to US dollar being the global reserve currency status. I don't think that will necessarily go back to a gold standard because it does limit a lot of, spending, and credit drives the economy. But what if we go back to what I mentioned before, New Bretton Woods being commodities backed, where every country use their own like commodities that they're exporting as the backing of their currency. In that scenario, even if we are to switch to that, in the medium term, I think that gold will play a part in terms of central banks all around the world to try to shore up the value of their own currency as they move away from the US dollar, as they move towards supporting their own currency with the commodities that they export. So eventually, new all-time high for gold and silver. For gold, I think the 2,400 in US dollar will be the first target. Silver, we've tried 50 multiple times. I think this time we'll hit it, and I have no idea where it'll go after. But I think, silver has been beaten down in in terms of in comparison to gold for so much more, and I think silver will be outperforming, and finally hit that 50 and break it this time. Now, history trend shows in a precious metals bull market that the first to rally are physical and then miners. First gold and then silver. The laggard, however, meaning miners to physical and silver to gold, will outperform. So the physical will move first and then the miners will move, but the miners will move further in percentage sense. Gold will move first and then silver, but silver will move further, again in percentage sense. In not my opinion, I'm personally more willing to take on risk, and so that's why I'm more heavily weighted towards silver than gold. And when it comes to miners, seniors will move first, and then the mid cap, and then small cap, but the small cap will move the furthest, but it is also the most riskiest. These are your explorers. In my opinion, I don't think there's a huge need to take that much risk in miners because they're already risky themselves. I think if by buying a sector ETF or just one of the bigger majors, you will already do fine enough, especially if you're looking into silver miners. For oil, now we're moved back above 77 for Brent. And with the new OPEC news, obviously the futures have not opened yet as the time of recording this video. So, I currently don't know yet, but I'm curious to see if this is sufficient to combat the recession trading and for oil to hold its ground. Again, eventually I think oil will make a new all-time high, back above 140. And the reason for that, again, is the long-term lack of sustainable reinvestment in terms of more oil production. And I think that will happen once the Fed surrenders to inflation, restart QE, looking like they already have, if that trend continues, and with rate cuts as well, and then I think, along with refilling of the US SPR, I think the wind is really on oil to rally to all-time high. Thanks for watching.